Great. This is Malcolm Turner of Castle Commercial Capital. Welcome to our YouTube channel. We're going to talk about bridge loan financing and the basics of how they work. First off, what is a bridge loan? Well, a bridge loan is basically short-term financing that you would use when you're trying to bridge a gap between where the property and the deal is and where conventional financing would come into place. And there's a gap there where I can't qualify, or my deal can't qualify, or my property can't qualify for commercial conventional financing. So bridge loans come into place when traditional financing is not an option, either because of speed, credit, occupancy, or it could be condition or other issues. So let's talk about for a moment what those things mean. When we talk about speed, sometimes you get into a situation where you need financing and I cannot go 60 days, 45 days, 30 days even. I absolutely positively have to close in like 10 days, 2 weeks, 3 weeks, 7 days. When speed is of utmost importance, where I'm going to lose the property or totally, whether I'm in default or my loan's maturing, or I'm in a situation where I'm buying a deal, and if I can't close in 2 weeks, the seller's going to move on to someone else because I'm out of contract, then that's where speed comes in traditional conventional commercial financing that will take anywhere from 45 to 60 days or longer is not going to work in those scenarios. That's where a bridge loan can come in. Second thing is when I'm dealing with credit, excuse me, where credit might be an issue, where let's say my credit score, I had a bump in my credit score down and I'm sitting at a 620. Well, traditional commercial financing, I'm going to have a tough time with a 620 credit score. When they really want to see 690, 700, 680 at the lowest. Okay, so if I'm talking about best rate financing, that's what I need. If I'm sitting at a 620 or a 600, that's going to be a problem. I'm not going to even qualify. Again, that's where a bridge loan can come in. Let's say also I'm dealing with occupancy issues, where maybe I've got a building and it's dark and I got zero occupancy, or maybe a situation where my occupancy is down to 50%. What we call stabilized occupancy is at 85%. If I'm at less than 85% occupancy of my commercial property, lenders frown on that, and traditional, again, conventional financing, they're not going to want to do that because they don't know at 50%, are you on your way up or on your way down? We're not going to take a chance. Come back when you get that other 30%, 35% occupancy, and we'll work with you. This is where a bridge loan can come into play. Also, condition. Maybe I've got a situation where my property is in need of major rehab. I've had a lot of deferred maintenance on it. I got to replace major systems. Maybe it needs a new electrical, it needs new plumbing, it needs new HVAC, those kinds of things where, again, traditional commercial financing may not apply in those scenarios. Well, they'll say, look, get that stuff done, then come back and we'll refi you. Or you don't qualify at all because maybe you got multiple issues. Maybe you got credit issues and occupancy issues and condition issues, and it's just too much and the deal can't happen. This is where bridge loans can come in because bridge loans will allow for all of those things. Now let's talk about property type. When you're dealing with bridge loans, you can do a bridge loan on multifamily, you can do a bridge loan on office, you can do a bridge loan on industrial. Most forms of commercial real estate, hotels, as an example, retail, all those things can qualify for bridge loans. And so, just about anything you can think of can qualify for bridge loans. The only challenge you may have if it's an owner-occupied property. Okay, so if I got a mechanic shop and it's my shop, I'm working out of it, I'm using it, there is no tenants, it's not investment real estate, then getting a bridge loan might be more challenging, but there's still bridge lenders out there that will do that. Let's talk about loan to value. Typically with bridge loans, you're going to see a loan to value of 60% on the low end to 80% on the high end. There's always exceptions to the rule, but generally it's going to be in that 60 to 80% range. And it will vary depending on the condition of the property, credit, income, the type of property that it is. Example, you can typically get a higher LTV on multifamily than you can on, say, retail. That's an example. So you will have some variances as well, and it will also have some variances between lenders, obviously. But generally, you're going to be in that 60 to 80% range. Now, as far as loan amount, you're going to be generally 250 up to 25 million, which is a pretty big cap. A lot of bridge lenders won't even sniff your deal out if it's not worth $1 million. Okay, so if you're under $1 million and you're between 250 and $1 million, you can still get a bridge loan, but your universe of providers is much smaller in that range. Let's talk about the term length. Bridge loans are temporary financing. It's just meant to bridge you from where you are now, where you're not qualifying for traditional financing, to where you can get full financing. And so in that case, this is where you're looking at anywhere from 6 months, 12 months, 18 months, 24 months are typical loan terms for bridge loans. And if you get to the end, by the way, if you got a 12-month bridge loan because you thought it would take you 12 months to cure the defect in the deal, maybe the defect was credit, and in 12 months I'm expecting my credit's going to be great, but in 12 months my credit's only at 660, not at 680 where I need it to be, I can ask for an extension with that bridge lender, and usually those extensions are in either 6-month or 12-month timeframes. Quick closings. Major advantage of bridge loans is that you can close fast. And so sometimes you may have a property that can qualify for traditional commercial financing, but you do a bridge loan anyway because you're negotiating a discount on your deal relative to the speed that you can close, especially if you got a seller who has had a couple deals fall through with financing. And then you come along and maybe you're offering them a good price, but they see financing and they're like, oh, here we go again. Okay. And if they've been strung out for 4 months, 5 months, 6 months, dealing with various lenders that can't finance their deal or borrowers who can't get financing, they get very wary when someone brings them a deal. Even if it's full price offer, if it's got financing, they're like, you know what, I've done this dance already. I don't think I want to play anymore. Okay. This is where a bridge loan can come in, where a bridge loan, you can say, you know what, I know you got your property listed at $1 million. However, I can close in 3 weeks, and but I would like to buy it for $850. Okay. I have investors that do that kind of stuff all the time, and they use the speed of the transaction to negotiate down a discount, because all we basically need to do a bridge loan qualifying wise is title, appraisal, and a credit report. It's not a whole lot involved relative to the paperwork. So it gets down to how fast can I get my appraisal done on that property. And the faster I get my appraisal done, usually with a bridge loan, you can close within 7 to 10 days of that appraisal being complete. And so I know at Castle Commercial Capital, we're a bridge lender. We can definitely close within 7 days all day long once we got the appraisal. Everything else moves quickly after that point. When you have a situation where speed is key, bridge loan is nothing's going to be better or faster than a bridge loan. Flexibility of documentation, I just sort of alluded to that. With a bridge loan, you don't have the documentation requirements of tax returns, operating statements, rent rolls, those kinds of things. So with a bridge loan, you can get a deal done and have, no paperwork at all. There's no income statements. They're just, again, looking at title, appraisal, and a credit report. That's about all you need. Let's talk about uses. There's very different uses of bridge loan, which I've alluded to. Obviously, one is purchases. You can use them to buy property. You can use them to buy property and fix property. So if you're doing so if you think about fix and flip with rental property, you can also do fix to flip with commercial. And there's some people that do that. They buy a commercial property that's, have a bad use, or it's not the best and highest use, as we like to say in the business, and they may redevelop it into something else. And then as soon as they get it full, and they get a tenant in there and they rehab it, then they go and sell it off to another investor. So you can use bridge loans for that. The other thing I mentioned earlier, obviously if it's a dark property and you have to go in, get the lights cut back on, get the utilities cut back on, do a lot of deferred maintenance, get tenants in there, you can use bridge loans to fund the acquisition and the renovation that can take place. You can also use bridge loans when you have a lot of TNI, tenant improvements. Okay, so I've got a property, maybe my occupancy is at 50%, maybe that's why I got a deal on let's say it was a strip center as an example, or office building. There's a lot of deferred maintenance. Okay, I can't get good quality tenants in there to fill up my building because I got old carpeting, I've got a decrepit HVAC system. Well, with a bridge loan, I can get the money I need to put the modern tenant improvements that good quality tenants want to see, to rent at a high value. Once I get those improvements done, I've now got the financing in place to pay off my contractors. I lease out tenants to market rate prices. And now my building is worth more, because in commercial, your building's value is a direct function of the amount of income that it's bringing in. So anything you can do to the building that's going to increase the income, i.e. increase the lease rates that you can charge your tenants, the better off you're going to be. The other thing you use a bridge loan for is when you got a partner buyout. So let's say I got a partner and he wants out. He wants to get out. He wants to go retire to, Florida or whatever. I need to buy this guy out. Well, now I need a loan. It's not quite a purchase because I already own it. Okay. So it's not really a purchase transaction. It's not really a cash out transaction in the way it's typically structured, because the cash is not going to me. And in the cash out refinance, all the cash is coming to me. Here it's going to someone who's walking away. So a partner buyout is sort of a hybrid transaction between a purchase and a refi, because you're taking cash out of the property like you would in a refi, but in like a purchase, you're giving it away to someone to buy their interests in the LLC that typically owns the property. And so bridge loans are great for doing partner buyouts. Also, if you have a minority interest and you're not someone who's buying the property, you just want out, okay, and you have 20% ownership in the LLC, and you're like, man, I need to make this illiquid liquid. A bridge loan is a good way for you to get your exit strategy out and get your 20% turned into liquid dollars that you can use to do something else with, and not have to refi the whole building. Because sometimes you have prepayment penalties, you have defeasance on the existing paper that's on that property, and it's just not feasible for the existing partners to refi the existing loan to pay off someone. And that's where you can have a bridge loan as a second on a property that can pay off that minority partner and make them, go away. The other thing you can use a bridge loan for that you can't do with traditional financing is when a loan's going into default. You got a loan that's maturing and I haven't made all my payments, I've been late on payments, and I'm in danger of getting foreclosed on. I can get a bridge loan on that property and pay off my old lender and make them go away and still get my deal done. And then whatever the defect was that caused me to be late, maybe it was an occupancy issue, and now I can have the money through the bridge loan to do the maintenance I need to get occupancy, or maybe I need to fund a marketing program. Again, same thing. The bridge loan will give me the money I need to cure the defect in the deal, so that 6 months, 12 months, 24 months down the road, I can now qualify for traditional financing. So I hope this was helpful to you guys. Bridge loans are an awesome device. Every commercial real estate investor should have it in their toolbox for various scenarios. If you need any more advice, or if you have questions, feel free to give me a call at 800-598-5530. I appreciate it if you like us down, hit that bell, and subscribe to our channel if you haven't already. We really appreciate that. Have a great day. Again, it's Malcolm Turner with Castle Commercial Capital.